conventional, USDA, FHA, all that stuff. But not everybody's going to fit into that little pocket, right? The market is changing, and there are a large underserved opportunity, which we are finding out. Uh, we were turning down borrowers back in 2019. We were kind of funny about non-QM, didn't really know if we wanted to get into that space, but we've tried it for a few years now, and we love it, and it helps out a large segment of our population, of our customers, and our realtor referral partners. How can portfolio loans help you close more deals? We're going to talk about that, and where can you find portfolio borrowers, and not to do, and what to do instead of best practices whenever you're dealing with these types of buyers. All right, so we are a one-stop shop here at Performance Mortgage. We do everything in-house. The underwriters work for me, the processors work for me, the closers work for me. It is my company. We have great people working here. We're actually in 8 states right now, and we're in a little town called Chalmette in St. Benoit Parish. I just don't have the accent. I'm originally from Lafayette. I just don't have the accent, but that's where I'm from. Came here after the storm, fell in love with the place, and here I am. But we service all of Louisiana, Mississippi, Texas, Florida, Ohio, Kentucky, North and South Carolina, and a few more on its way. But back to what we were doing. So a lot of your loans, 80% are straight down the fairway, conventional products, FHA loans, USDA. And it's starting to get a little bit more to where it's not just 80% of our loans, like, non-QM is almost to about 30%. So it's really starting to be a big part of our volume. 20% of portfolio non-QM products is traditionally how much we've been doing in non-QM. And let's just talk about, why does this matter? Close just 3 more deals a year using portfolio products, and you can increase your commission by $54,000 depending on what your typical home that you sell. I mean, it goes up big time. All right. I mean, we're not talking about a whole lot to make this happen. So what are the types of these home buyers? Now let's go. Are you missing deals because you're not aware of loan options for self-employed home buyers? Let me tell you about, these are awesome, okay? These are probably the easiest and really what non-QM is for, okay? So if you have a 1099 earner or jumbo borrowers, which of course they just went up significantly on conventional, but I mean, we can go up to $2-3 million, some as little as 5% down. That's considered a non-QM because it's over the conforming limit. So jumbo does fit in that non-QM space. Self-employed, agency fallout borrowers, and business owners. If you're missing deals for home buyers that have had a recent life or credit event, right? Whether it be foreclosures, bankruptcies, something that just happened, this could have been from short sales, divorces, medical issues, COVID, recent mortgage rates, different things like that, we can help. Now, let me just tell you this. These loans are not for your borrowers that are needing 100% financing, right? In order for it to make sense for the investor, like, there is some skin in the game, which we'll go over. Are you missing out on deals because you think real estate investors won't qualify? Oh my, guys, y'all are going to stay tuned. You're going to love this. If you have an investor that has a half decent credit score and has money in the bank to invest, you're going to want to hear this, because we don't care about taxes. We don't care about anything. I'll let you know. And the number that they want to get, we don't care about as well. Are you missing out on deals for home buyers who can't verify income? I know that's happened a lot, right? In other words, they get paid cash money or they're 1099 or whatever it may be. So if we have a borrower that doesn't necessarily have income, but has, like, say, $500,000, $700,000 chilling in the bank, or it don't have to be that much, $200,000-$300,000. We can actually use that to derive income. Okay, it's called asset depletion. So we're talking about loans for self-employed borrowers, jumbo borrowers, people with credit issues and life events, asset qualification. In other words, they have a bunch of money in the bank or stocks and stuff like that, but maybe not a whole lot of income, and investor loans. That's what's mostly what these non-QM loans are for. It's happened so many times where, you might have referred a loan to one of your lenders and they pull the credits like, oh man, they're solid, but they know they're self-employed. And then by the time they've gotten all the paperwork, uh, and they estimated the wrong amount of income possibly, or there just wasn't enough income as far as what the bank statements are, we have an awesome program for that. It's called the bank statement. And what we do is we're going to ask for 24 months bank statements. We don't have to have 24 months, but with performance, more is better, especially if you're trying to get them qualified for a higher amount in some cases. So what we're able to do is we're able to get 24 months of business bank statements or 12 months. There's two different programs. And then we can average those out and see exactly based on deposits what we can give them for their income. So even though it's non-QM, that allows us with the federal government to say, hey, we figured the ability to repay based on deposits from the bank statements. Now, typically, once say there is their business bank statements, it can also be personal if they're 1099, right? And they're just a sole proprietor. But they get their business bank statements, typically we're going to need to deduct 50% of that. So if we show that they've had $100,000 in deposits, normally we're going to have to just cut it 50% and say, you know what, they didn't make 100, they made 50,000, right? Well, their tax returns might show that they made negative 25,000 even after you're adding back depreciation or whatever else, right? So it is definitely something to look into, and it's a good program when it comes to that. Now, a lot of times we can get over the 50% deduction if a CPA will validate and say, you know what, for this particular field, it's not necessarily 50% of expenses, it's only 25%. In my experience, that's easier said than done. I've had some success with some CPAs that account for the business, but some CPAs refuse to do that. So it's just a matter of who the borrower is working with at that time. Also, if the business is getting deposits and then they're making draws, like a capital draw from owner's investment into their personal account, and they can show 12 months of doing that, we can actually take those deposits and then take about 3 months of the business deposits and business bank account deposits and show that the business is the one taking care of all the expenses. Here's the 12 months, divide that by 12, and actually use 100% of that income. A lot of our borrowers have come and didn't necessarily want to get the house that they wanted. We couldn't approve them, but I set them up and said, listen, start taking your draw more, and then in 6-7 months we can start look at your bank statements again and see exactly what's up, and then we've been able to get them to qualify that way as well. So a great program and very nice. Now, these bank statement loans also, it's just a way of figuring out their income, right? Their ability to repay. But it can be used on a jumbo loan, it can be used on investment loans. It's just a way that we figure out income to be able to still, even though it's a non-QM mortgage, still qualify as a way to show how the borrower is able to make their payments. And in this case, it's strictly cash flow, right? So for an example, self-employed borrower makes 200K per year and has a credit score of 758, writes off 75% of his income. I don't know how many times I've seen that, right? Of course, why not? That's the whole reason about being self-employed. You get to write it off, and Uncle Sam don't get as much, hopefully, right? Now he's left with 50K trying to qualify for a jumbo loan, and he doesn't qualify. Well, it's real simple. Loan scenarios like this, our loan officers put it together, get it approved, and then they get their jumbo loan and they're rocking and rolling $750,000 loan because we see the cash flow comes in and we see that they meet the ability to repay. Have you ever lost any closing deals because buyers had recent credit events, right? Okay, give me a scenario. This is a little bit old. It wasn't quite last week. It was late last year. We closed on a $1.3 million home for a family that was turned down by two other lenders due to foreclosure that occurred 2 years ago. Our full doc program, we enabled this grateful family to move into their dream home just to enjoy it in time for it was around the Christmas time. Now, did they have to put down a lot of money? Absolutely. They did, right? But at the same time, it still made sense. The loan to value still made sense, and we're rock and rolling. I want to say for this particular one, they actually put down 30%. Are you losing out on closing deals because buyers cannot qualify. Let me give you another scenario, okay? A buyer recently sold their multi-million-dollar business. She started a new business less than 2 years ago. When she tried to qualify for a loan, it was rejected since she didn't have a long enough self-employment history. Her plans for moving into her dream home were almost derailed. Definitely not that great of planning for our entrepreneur that had already sold and looking into getting into another venture. But at the same time, it's all cash flow, guys. So we're still going to look at statements. We're still going to look at uh, cash deposits and their bank statements and be able to approve them that way. All right. Or in this case, the borrower actually got a bunch of money for her business and we were able to use it through the asset qualifier. In other words, she don't have to pay it cash. That would be a travesty, right? Especially if she's doing another startup. I'm sure the cash that she got from her banks, from the sale of her business, she's going to need it on her new venture. Well, she was able to keep a lot of her cash and get this deal done because of that. She had it. We were able to calculate her ability to repay based on asset depletion. So that's a really good example as well. Are you losing out in closing deals because buyers are investors? So let me give you another scenario. An investor is looking to purchase her 19th investment home, right? Now, if you've been around the block, you already know Fannie and Freddie, it's 10, 10 and you're done, right? Now, you can have 10, your husband or wife can have 10, vice versa, your kids if you're wanting to do property accumulation, but as far as in somebody's name. Her prior funding was very costly because it was hard money with high rates and fees. She was unable to qualify for a mortgage using tax returns, right? I don't know if you do this, it's a whole nother webinar, but we do fix and flips and all kind of hard money. And hard money does make sense, but that's not what we're talking about in this scenario. After rental analysis was completed, she was able to qualify using our investor cash flow program, which is awesome for her 19th home. Ladies and gentlemen, listen to me when it comes to investment. Treat them good. As far as investment loans are concerned, if they have the 20% down, which we're actually rolling out a 15% down investment loan program, right? To where they have to put down, if they're under a 720 credit score, all we care about, they can go all the way down to 640, I think we're going down to now. It just depends who we're selling to. Sometimes they'll tighten it up, but right now it's 640 for those. If they have the down payment, all they care is that the PITI, the principal, interest, taxes, and insurance equals 1 to the rent. So if your PITI's 2,000 and your rent's 2,000, you're good. If your PITI's 2,000 and your rent is 2,200, you're good. Now, here's what's even crazier, right? Which I haven't had one yet because mostly, with rent being so high, they actually cash flow. If they have a 720 credit score or higher, all that goes out the window. We don't care. If you want to do something with a deficit from PITI to rent, go for it, no problem, right? But you have to have the down payment. Now, how much do they have to make a year to qualify? Guess what? We do not care. Nor do we ask, to provide those documentations. These particular deals right now normally are, hey, let me see your assets, verify they're correct, do a credit pull, find your house, get clear title, get appraisal, and for the most part, close on your loan. They are so simple, and we do them all the time, and we are able to bang these out so fast because the processing it's a lot less time consuming when it comes to figuring out the different tax, income and stuff like that. Now, a lot of times people come to us, and first, if they don't have all the 10 slots, we'll try to see if they can qualify for a conforming type loan because it does have more advantageous interest rates when it comes to it, right? With these types of loans, typically you're always going to be paying some types of points. Normally it's 2 to 2.5% of the loan amount in order to get this deal done. But it still beats rent in a lot of cases, and it still cash flows if somebody is trying to get a rental portfolio going. So that's awesome. We were able to save all these deals because we work with these types of buyers every day. Self-employed with significant write-offs, recent credit events, 2 years, buyers with significant assets, investors with specific programs. These are our bread and butter when it comes to these non-QMs, but at the same time, we do all the manila conforming. So, I mean, there's huge potential for closing more loans. Investors, okay? 36% of homes are rentals. I don't know if you all know this, but the hedge funds in the past few years have just been buying up bulk REOs here and there and actually creating rental out of them and then turning around and securitizing them, selling them on Wall Street for big money, right? And then just getting those payments. So that's a big thing, and it's actually decreased a lot of the, maybe not so much in Louisiana, but across the nation has decreased the housing inventory because they're not building fast enough to keep up with the demand. So 10 to 11 million number of individual investor landlords managing an average of 2 units each, right? How many of the investors that you know that just couldn't qualify to buy? They had the money, they had the credit, they just didn't have the income. Well, these are the loans for them. All right. Same with your self-employed. 36% of U.S. workers are gig workers in some capacities. Like I'm out of Chalmette. We do a lot of movie people where they're building, right now they're building this huge, it looks like they're building New Orleans uh, in the middle of the Imagination Station with Sidney Torres where he does all that parking lot. Those are the type of people that will do. They'll work 3 months, then they might be off for a month, and another movie comes back, they go back. Or turnarounds, Boilermakers, things like that, that might not have a whole lot of income where they're showing up. These are perfect for these types of people if they're writing everything off. Sometimes these turnaround people, they'll do 1099, not so much W-2. So it just depends on what plant they're working for and just what type of business that they're working for where this could actually work for them. 59 million people categorized in the gig economy. In other words, as something comes up, they do it. When it's not, they're chilling. 17 million people categorized as self-employed. All right. Same thing with adverse credit. 5 million plus number of foreclosures filing since 2014. Now, that hasn't been as big of a deal as of late, but again, it's still one of those borrowers. I've had them where they've been 2 years out of a foreclosure. FHA wants 3 years unless there's serious compensating factors. Those compensating factors never appear because somebody literally has to die. The death of a wage earner has to die. Them being in the hospital or anything like that, I've never been able to get approved as a compensating factor. So the only thing that's ever worked is the compensating factor was death of a wage earner that was responsible for the note. So those are tough, right? Or bankruptcy or anything like that. So these are loans, these are customers that you can actually get to the closing table, and they are not that hard. They're actually easier, in my opinion, than that of a conforming loan. A lot of realtors ask me, it's like, well, I have some, but where can I find more portfolio borrowers? I mean, y'all already know that. It can be social media. Revisit any recent turn down in your book of business. And look, we're going to show you how you can maybe all these types of leads or deals that you're working that just flowed through. We're going to show you how we can maybe bring them back to life for you at the end of this presentation, free of charge. You're going to love it. Builders and developers, right? Builders love this stuff. That's just another way to sell a house. Now, they're not having as much of a problem now because if it's a nice house, they're getting seriously um, a bunch of offers, right? But at the same time, traditionally, maybe not today's world, but in traditional times, these are normally a good way to get that. Accountants, CPAs, same place where I'm getting a lot of my business. Financial planners, bankruptcy or divorce attorneys. That's a good one, right? Hey, they got a divorce and they had to bankruptcy. Yeah, these guys are two years out or whatever. That's public record, bankruptcy. And then that'd be some leads as far as that's concerned. Now, what should you not do? Do not tell your self-employed borrower to not claim deductions for 2 years so that they can qualify for a conventional loan. I just really think that is not necessary. If you have deductions and there's a thin line between tax preparation and tax evasion. Okay. So if they're doing good tax preparation and they're actually having them, you don't want people to pay more just so that they can qualify, right? They will miss out on 2 years of appreciation and tax benefit in the hope of saving a little on a rate. And who knows where rates will be in 2 years, right? So strike while the iron's hot. If they can get it done now, then they can go from there. Instead, call me first to advise them how. Don't tell them not to do this thing. Of course, your lender that you're using right now might, but don't tell them that. tell them to give us a call, and we're going to go over everything with them. And you might be surprised. Your turn down from the lender that you normally use might be our approval. So, what not to do. Do not turn away buyers who suffered financial harm from COVID pandemic. Circumstances include the payroll protection plan loan, right? If they've gotten that or accepted a forbearance. That's big. I know that hurts us for FHA, USDA, any type of conforming loan. Or lost income. We might still be able to help them. Do not turn them away without letting us look at them first. Instead, give me a call. Do not tell your investor they own too many properties for you to help them. Man, we want them to buy the world, right? If they feel comfortable and they have everything it takes and good property management, whether you're providing them that or not, let's sell them the world if it makes sense for them. With my investor cash flow program, the total number of properties, they don't matter. We don't care how much he's making. We just care about the property and we care about the down payment, which typically is about 20%, 20 to 25%. As the credit goes up, the down payment is not as much. As the credit is lower, the down payment, of course, increases. Call me first. Do not automatically turn away a borrower with a complicated financial situation. Instead, call us. We are here to help. Not only do we want your non-QM business, of course, we want all your business, or at least have a shot at it to show you how we can help you help yourself, making more money, getting more borrowers approved, and going to the closing table. That's what we're all about. What do you get when you call me? I love this slide. Access to a wide variety of programs to help your buyers with complicated financial situations. Also, any loan officer that works directly for corporate or even in our outside branches are tried and true. They've earned the performance badge. Okay. In other words, our name is our mantra. We want to perform, and they know what they're talking about. In a lot of cases, I still originate because I love it. I don't have to. I love it. And you could send them to me as well. And I promise you one thing, I do not need the practice. So I'll be able to get through it real quick, tell you exactly what's up, the pros, the cons of the situation, and what to expect so that we can keep on moving on. Our ability to pre-qualify potential buyers, even self-employed people, so you know their income before showing homes. We always do that. We're not going to sit there and throw stuff against the wall and hope it sticks. In this business and in this day and age, there's still too much that we don't control that can come up. Title issues, appraisal issues, judgments that weren't shown up on fraud, that come up on title when the titles ran. There's other things that we can't control, but we try to get to as soon as possible so that we know we're not wasting anybody's time. Now, just send a borrower out there because he has a pretty credit score and you haven't even decided to get his paperwork to see exactly what he makes and what type of loan program you're going to do. There is a lot of that going on around right now, and I think it's horrible. You don't want to waste sellers' time. I wouldn't want it done to me. You don't want to waste buyers' time, and you don't want to waste your realtors' time that are looking forward or maybe really depending on that closing to go through and to go through on time. We have an operations team that is quick and smooth to closing. We have all our day one certainties. If they're doing conforming loans, we send it out. We can actually get their payroll, everything up front, run it through DU. Sometimes it's a 10, 15-minute process, and we actually have a firm commitment through underwriting through the computer. Now, our underwriting staff is still going to review it and double check it, but typically that is ready to go. That's a hard approval, especially if we're getting it through day one certainties, which is assets that come directly from the bank, verification of income that comes directly from the employer, and pay stubs and stuff that typically allows them to log into like ADP, Paycheck City, different places like that, to where it automatically sends it to us direct. And that's how we're able to get these faster approvals. That, for the most part, is your conforming type loans, which we do first. And then from there, if that doesn't work, it's non-QM, baby, and it's been working great. So what I want you to do, I know this has been a 26, almost 30-minute presentation. I appreciate y'all sticking with us this long. There is a lot of money to be made in this space. There is a lot of people to help. There is a lot of people and customers that are in your database right now that we can help you with. And what I want you to do is show you at no cost to you, free of charge, how you can get your own marketing campaign your loan officers just with your turn down leads or just your stale leads, and show you how my team and I will, we're going to, you click at, click here, and that'll go right to a place where you can go and set up a meeting with me based on my calendar availabilities. And we'll talk, we'll do a Zoom call. We'll show you exactly what we do and how our follow-up process works. Just a little bit of tidbit how it works, a little tidbit of information is, if you got an old database, we'll actually, that's of old leads, we'll actually put that in to our marketing campaigns, whether you have emails or whatever, and start marketing them through Google pay-per-click and stuff like that, and then showing them the different types of non-QMs to where they can look. And so if they're still in the market, they're going to start reaching out to us. Also, we will be calling them, right? We'll be calling them. Now, if they tell us not to call them, of course, we put them on the do not call list. But as of right now, I would imagine most of these leads, if it's Realtor.com, Zillow, Boomtown, wherever it's coming from, Zapier, from your own squeeze pages or whatever, we do all that stuff too. They've already opted in, so it's free game, and we go from there. Now, are we going to just bother the dog out of them? Absolutely not. It's going to be very light when it comes to, a text, an email, a voicemail, and then a live call, things like that. Not all in the same day. It's just staggered. And as the time goes on, what we see is a lot of the borrowers that you might have passed up on or maybe couldn't have got a hold of, typically a Realtor.com borrower, that's about, or Zillow or whatever, that's about as good as it's going to get. They're raising their hand and saying, hey, I'm interested in this particular house, right? Nobody wants to get a loan because it's not sexy. But we've noticed a lot of those borrowers, most salesmen only call their leads maybe twice, if that. And from our data, because we are data junkies, it's taken about 9 points of contact. Now, I don't have to all be phone calls, right? But with conjunction of automation systems to where it makes it to where it does it, we have it to where it looks like it's not a robot. Okay, they're sending them everything, letting them know exactly what's up, giving them some information, giving them some value so that they can better know if they want to proceed with us. And then once they respond, we're on it, right? Picking up the phone call, send them over a calendar invite, whatever, to try to get them in front of you. Now, once we pre-approve them, we're going to get them right back to you. And then, I'm hoping after all that work, you're going to go and get us some contracts. All right. So that's how it works. If you want to know more, we have a lot more to discuss. Take about a 30-minute conversation to get the ball rolling so we can show you exactly what we do. So feel free just to click on this link and schedule the appointment. And thank you so much for tuning in. We really appreciate it. And we look forward to not only working with you, we look forward to earning your business.